Good afternoon, everyone. Welcome to the RealNex Commercial Real Estate Market Update with Dr. Jeffrey Fisher. I'm Jeff Finn, CEO at RealNex, and as always, we're pleased to host Dr. Fisher and welcome all of you into the webinar. Probably more important than ever this time around, as we've all of the sessions in the past have just been another record, another record, another record, and now we are in a whole new world. So Jeff is going to bring a great deal of insight to where we're at and for some feedback on where institutional investors think we're headed based on the research that he's done with NCREIF and others. Interesting times, lots of opportunities, lots of challenges, and no one has the perfect crystal ball, but at least we'll have the data to set the foundation for future thought of how to invest, how to transact, and how to move forward in the market. As people are filling the room, we still have a lot of people joining, so welcome. See many of you have been with us for session after session, so welcome back. A lot of new faces as well, which is great. A lot of existing RealNex clients, which we appreciate to see, and some that haven't been and aren't as familiar. So I'm going to do a quick little video on RealNex as an introduction, then we'll turn the mic over to Jeff and the presentation will get started.
Business as usual isn't good enough anymore. The future belongs to the technology-advantaged power broker. Power brokers get more deals done faster with RealNex, the most complete commercial real estate technology solution for fast lead generation, complete financial analysis, beautiful presentations, stimulating marketing, and successful deal management. With RealNex, power brokers quickly profile people and properties to most efficiently prospect for new business, manage deals, and report on activity. No one knows the market better than a RealNex power broker. They have complete data on market inventory, comparable sales and leases, hidden spaces, and the most active buyers, sellers, and tenants. They efficiently collaborate with clients using the RealNex Tourbook leasing app and run accelerated sales processes in private and secure deal rooms. Power brokers eliminate redundancies and save time with automated investment and comparative lease analyses, and they swiftly create an incredible array of professional, elegant, and consistently branded marketing materials. When it's time to go to market, a RealNex power broker can economically run highly targeted e-marketing campaigns to their private prospect lists, or instantly tap into the vast RealNex community to assure no stone is left unturned. Power brokers can even leverage 3D virtual reality to improve deal cycle times for buildings and spaces, and instantly assure clients the space works perfectly for them. Power brokers effortlessly impress their clients to instantly save more time and make more money. The future is now. You too can be a power broker. Boost your results. Sign up for RealNex today.
All right, we've made incredible advances to the RealNex platform since the beginning of the year, and most recently we've done a tremendous amount of work. Jeff in particular has been working with us to enhance the lease analysis platform, and it's fantastic enhancement to, particularly in this part of the market where we're in such disarray with tenants that have been closed down, not collecting income and unable to pay rent, to be able to look at lease renegotiations and lease restructuring. So something that many of you haven't looked at in the past, you might want to take a look at fresh, the lease tools part of Market Edge, to see how you can help your tenants and landlords bridge the gap and come together on lease restructuring, whether it's a blend and extend or new leases and new opportunities in the market. But just a great new enhancement that we have just released, and I know you'll enjoy. So Jeff, thanks for working with us on that, and I'll turn the stage over to you.
Okay, thank you, Jeff. I assume you see my screen now and you can hear me?
Yep.
So we got the CRE market update for this quarter, subtitled, "What do we know about the impact of COVID-19 so far?" Which I wish was more than we know, but we'll see what the thinking is and what we do know at this point. I added this slide this morning just based on news that I saw from Globe Street, just as I was waking up this morning, and you get the latest industry news. Commercial real estate transactions in the U.S. plunged 71% in April. Sales of U.S. hotels, offices, malls, and other commercial real estate plunged 71%, the lowest level in a decade. The U.S. market for hotel properties is frozen. Industrial or institutional real estate investors worry about unstable property appraisals, and that's from an organization called the Pension Real Estate Association, which is the same kind of folks that contribute to the data that I'll be talking about today. And as you know from past webinars, if you were on some of the previous ones, we'll be using data from institutional investors where they have to mark their properties to market every quarter, so we can see what they are doing in terms of changing market values and how that impacts their performance. This is also from a quote from Sam Zell. Some of you may remember Sam Zell is the grave dancer from the recession we had back in the late 80s, early 90s, when he was buying properties 50 cents on a dollar. But he's saying sellers still remember the price they would have gotten early March, and buyers think about the price they dream of getting right now, and it's going to take a little while for that all to sort itself out. And that's really kind of the situation we're in right now, where transactions have dried up. People are trying to figure out where pricing is, and how COVID-19 is impacting different property types, and what the new normal is going to look like. And it's going to take a little while, I think, to sort all that out. But one of the things I did was to try to look at past recessions, and just to get an idea, maybe it's a worst case scenario, as to what could happen if we do move into a recession. Looks like we're going to be in one, maybe not the official definition, just kind of depends on what happens to GNP growth this quarter and next quarter. But if we look back over time, this is a market value index for real estate, and we see the impacts of the early 1990s recession, and then we see the tech bust, a little bit of an impact on commercial real estate, and then the more recent great financial crisis, the Great Recession, and what that did to property values. And so for each of those, I looked at what that did to commercial real estate, and you can see with the 90s recession, that really took a long time to recover, and investors were slow to write properties down, and it also took a while to get them written back up again. So 44 months from the time it started until we got back to the pre-recession peak. 9/11, much smaller impact, actually very little impact on commercial real estate. And then the 90s, the more recent financial crisis, you can see that's more of a V shape, where the write-downs were quick, and then the recovery as a result was much quicker. Now, if we go back and compare real estate with the S&P 500 and REITs, one of the reasons I did this is, we've all seen what's happened to the S&P 500, especially in April, and we've had some recovery since then. But the question would be, is real estate and REITs going to follow what's happened with the S&P 500? And so we saw that in the early 90s, S&P 500 actually recovered pretty quickly. REITs took about 24 months to recover, but you can see they dropped in value more than the real estate, the private equity real estate. When we say real estate here, it's private equity. But then a longer time to get back to the pre-recession peak in the early 90s recession. We go to the tech bust, and I was surprised how long it took the S&P 500 to get back to the pre-recession peak. Took 25 quarters to get back to the pre-recession peak in stock prices, whereas REITs recovered very quickly, just within about 4 quarters, maybe even less than that, 3 quarters, until they get back to the pre-recession peak. Real estate, private equity took a little bit longer, but you can see there wasn't really that much of an impact either. So even though it took 8-9 quarters to get back to the pre-recession peak, we're talking about a very, very minor drop in values due to that. Now we go to the more recent financial crisis, and we see the direct investments in properties. The NCREIF Property Index is again the real estate, the green line. We see that took longer than the S&P 500, although not a lot longer. What really surprised me when I did this is REITs took the longest time to recover. Took longer than the private equity to get back to the pre-recession peak. A lot of times it's argued that REITs are a leading indicator of what's going to happen in the private market, with the idea that the public market with transactions every day, hourly or minute by minute, it captures changes in market conditions more quickly than the private equity based on appraisals. But interestingly enough, the appraisal based private equity market recovered sooner than REITs in the more recent financial crisis. I also added on here, and I have it on a later slide too, the non-NPI properties. These are properties that are not part of the official NCREIF Property Index that's used as a benchmark, and it's primarily driven by self-storage and senior living. And it's kind of interesting that really held up the best of all these different alternatives here. During the financial crisis anyway, senior living and self-storage did quite well relative to the others. I don't know if that's going to be the case this time, especially for senior living. This was a slide I got from Bob White, who's the president and founder of Real Capital Analytics. Many of you may be familiar with. They track every transaction over $2.5 million in the U.S. and do similar tracking of cap rates and transactions globally, and who the buyers and sellers are. And this ties in with my previous slides nicely. Bob and I kind of exchanged slides, and you can see where initially you've got a shock like we've had here with COVID-19, and so it takes maybe 18 to 24 months to sort of figure out what's going on. Maybe it'll be sooner this time, but to really digest the impacts. But at the same time, you're starting to have price discovery. The price discovery starts off slow, and really it's 6 to 9 months after the initial shock that you really have an understanding of what's going on with pricing. So we're in that period now, as I mentioned as we started, that we're still trying to figure out pricing and where things are going to end up. But then you have the workout period, which you all should be getting ready for, where there is activity, people taking advantage of the pricing and betting on the recovery. And this is kind of based on the financial crisis, so we don't know if the timing is going to be the same this go around, but it kind of gives you an idea, at least what we can learn from history. This will give you an idea of, for the financial crisis, the percentage that property values dropped. And so you see the number less than 10% had a 10% or less drop in value. It peaked at 30% of the properties having 20 to 30% drop in value, and then it goes on up to whether it was even some that lost all their value, 90 to 100%. Not a lot, but there certainly were some properties that just lost all their value during the financial crisis. And then this shows a breakdown by property type of what happened starting again at the beginning of the financial crisis and tracking through to everything's recovered except hotels. I was surprised when I did this. Hotels never have gotten back to the pre-financial crisis peak in values. Now I do have to say that within this particular database and index, there's very few hotels, although the ones that are in here are certainly the high-end institutional quality hotels. But there's not a lot of hotels held by the institutional investors. So this is a smaller sample, but still, this does not bode well for the future of hotels. because of course those have been really impacted by the current COVID-19. So, and then we see retail here was actually we end up, as you well, we all know what's happened to retail in recent years, but it actually recovered pretty quickly the last go around. But as we'll see as we move along here, retail and hotel was certainly hurt the most, at least so far in the current situation. And then this adds the senior living to the analysis. Senior living didn't do too bad last go around anyway. This is a comparison across a lot of different property types. As a reminder, the NPI is the NCREIF property index. So think of that as the private equity real estate held by the institutional investors. So it did eke out a slightly positive return for this first quarter. That's the brown bar. So on the far left, we see 0.7%. So combining all the property types together, we did eke out a slightly positive return this quarter. And I don't think it would have surprised people if it didn't turn negative. And as we'll see later, it did turn negative for hotels and retail. If we move over to the far right, you see NAREIT, which is your publicly traded REITs. And as of the end of the quarter, so remember we're talking March 31st, right? So keep in mind as we go through some of these slides, we were still kind of learning about what's going on with COVID-19 at that point in time, and so REITs were down at that time in terms of the NAREIT index. All equity REITs down 23%. So REITs way down compared to private equity. So actually, I got a call from a Wall Street Journal reporter yesterday saying, "Well, why is there such a difference between the performance of the private equity real estate held by the institutional investors and the REITs?" And I think part of the answer to that is you look at the S&P 500, it was also down quite a bit, 19.6%. And I think when you securitize real estate and it's traded on the stock exchange, it tends to move with the overall market. So I think to some extent that's just REITs going along with the rest of the market. But to be honest, we have to admit that appraisers at the time they were finishing up valuations for the end of the first quarter weren't quite sure how to revalue properties. That a lot of the appraisals had already been done, and they were scrambling to revise them because they're working on appraisals the last at least the last month of the quarter. Then all of a sudden, we're seeing the events of COVID-19 impacting the stock market and REITs, and it's like, oh, gee, how much do we need to revise our appraised values? And I think the focus was on hotels and retail, where they knew the impact was going to be the greatest, but they didn't have transactions. As we saw, transactions activity way down. So if you don't have transactions, it's hard to know what kind of price to put on a property. So my conclusion is, the truth is probably that values went down more than we saw in the end of quarter numbers, but I don't think as much as we saw in NAREIT. In fact, REITs have recovered quite a bit from that minus 23% since the end of the quarter. So just gonna have to wait, I guess, and see what happens over the next quarter. So as I talked about the NCREIF property index returns, these are unlevered returns. The quarterly returns did eke out a slightly positive return, although it was the lowest that we've had in 10 years. We have to go back to as the time we were recovering from the financial crisis to see a return this low, but still positive. So keeping in mind that these are returns for the institutional investors, what do you think that unlevered return is going to be for the entire year 2020? Do we think it's going to be below a negative 2%? Do we think it's going to be 2% to -1, -1 to 0? And we'll see if anybody votes for above 0, positive.
give everyone just a few more seconds, Jeff, and give the results out.
This will be interesting.
It's going to be very, very interesting. So see how
I think we got a number of interesting
group
questions
is
this time.
a little bit different than in past. So polls closing. Get your vote in. Here we go. Share the results. I think you can't see them, Jeff, so let me read them for you.
I might be able to click on something and see them, but go ahead.
So it's pretty diverse and interesting, and it may be surprising to you. The negative, below negative 2%. So anything 2% minus 2 or greater, 30%. So about a third. And the other 31% negative 2 to negative 1. So they thought down, but not too much. Negative 1 to 0, 22%. And positive returns, 17% thought there would be positive returns. So I think
That's interesting.
your guess of 0.
Yeah, maybe that's betting, we're going to have a vaccine, life is going to get back to normal. The restaurants are going to open up, maybe it's a lower capacity, but maybe, and the casinos will open up here in Vegas, Jeff, and you can come out and visit me.
Yeah, I look forward to it.
That's very interesting. That's more optimistic than we had from the institutional investors. I think we only had about 1% that were positive, but it was mixed between the -2 and the -2 to -1, and we had some people 1 to 0, but hardly anybody that was above 0%. Okay. This actually is a slide using the NCREIF data, but was added by my one of my co-presenters. Had two of them at the webinar that we did for the institutional investors, for the NCREIF members, and the director of research for Hines had put this together to present to their investment committee, where they're showing on the same graph the appreciation return. Odyssey, hate to throw out new acronyms to you, although some of you have seen this before. That's an index of a certain type of real estate fund. ODCE stands for open end. Those are open end funds that are well diversified, and they're core equity funds, the core being the lowest risk of the equity funds. So these are fund returns, but they're pretty similar to the property returns we've been talking about. And you can see that the return, again, just slightly positive in terms of in this case, the appreciation return, which is your change in value. So just slightly positive for the funds. But if you look at the capital flows, you can see the capital flows have become negative. In other words, there's more people taking money out of the funds than there is money going into the funds. And these would be the open-end funds that, a lot of the plan sponsors, the CalPERS, the CalSTRS of the world put their money in, that are managed by the different institutional investors. JP Morgan, Morgan Stanley, all the different managers have these open-end diversified core equity funds. And so you can see one of the points here was there's certainly a relationship between the capital flows and the returns. And as people are taking money out of funds, that's usually at a time when the returns are falling, and vice versa. The question is always which comes first. Is it less capital going into real estate causing returns to drop, or returns dropping causing people to put less capital in? And sometimes it's hard to sort that out. And this is also a slide by the fellow from Hines to say, hey, this is the first write down in 10 years, which I've already mentioned, but just another way to show it, that for the first time in 10 years, we've got write downs of properties. Excuse me. So this is a index of market values over time, starting with 2010. And again, it just shows how we've got that drop, because my circle moved when I resized the graph. So think of this circle as being over here where it drops down a little bit this quarter, just to show you that although we had a little bit of a drop back in 2017, this is really pretty much the first time since we were recovering from the financial crisis that we had a drop in values in terms of this market value index. So the question would be, how far will market values drop before we return to the pre-COVID-19 level? Kind of related to what we talked about for returns, but could values drop by 0 to 10%, 10 to 20%, 20 to 30%? Maybe I should have had some positives in here instead of all negatives. But I think everybody pretty much thinks that, well, we've already had some drop. So I guess it has to be at least 0 to 10% because we've already seen a little bit of a drop. So is it going to stay in that 0 to 10% range or be more than that? And this is till we get completely out of this. You saw what happened in previous recessions, so you know it certainly could be the more than 30%.
Let's see what the market feedback is. The poll is closed. The results are in. 26%, Jeff, in the first tranche of 0 to 10. So quarter of you think just a slight drop. 44%, the largest group, say 10 to 20. And then another quarter, 24%, 20 to 30, and 6% are really concerned that it's going to be significant with more than 30%. Sorry about the typo there, more than 30% drop.
That's interesting. And I'm thinking, Jeff, in a way, it's good that we have such a diversion of opinions because that's what makes a market, right?
Exactly.
You know, when it's down 10%, you know, there'll be people that say, hey, that's it, I'm going to start buying, and there'll be other people that think it's going to get worse, and they're the sellers, and we got a market. So
that's the way it works.
As we know, there's people that are making money in up markets and down markets. It's a question of timing and having some deep pockets. So the components of the return, this breaks down where if we're getting our return from cash yield, which we are, from NOI growth. Well, we still got some NOI growth. Cap rate change, nope. We can't rely on cap rates going down. In fact, they may go up. And then because it never adds up exactly mathematically, you got some other effects in there. So now we got to keep in mind that when we talk about cash yield here, these properties are marked to market every quarter. So if the cash flow goes down, the values are going down, and so you still got a cash yield. It's just based on a lower value. But certainly cash yield and NOI growth is going to be a key to what's going to happen to returns going forward, and what happens to cap rates. They haven't moved much, as we'll see yet, but they certainly could move up if there's additional risk put on, at least on certain property types, forcing cap rates up, and less NOI growth would also cause cap rates to tend to go up. And this looks at the cap rates compared to 90-day treasuries and BAAs in particular are good to look at, especially the BAAs. A lot of people look at cap rates compared to treasuries, but really a better indicator of cap rates is that BAAA yield. You can see that at least starting with 2000, they really, except for a little bit of time during the financial crisis where they departed, they're really pretty highly correlated. So a lot of what happens to cap rates may depend on what happens to the BAAA yields, although I don't think there was much, except for during the financial crisis, a change in the risk that was being put into the cap rates. And so again, we may see some more risk premiums in cap rates going forward, at least for a while. So what will cap rates be for the nation by the end of 2020? You think they'll be below 4%, 4 to 5%, kind of where we are now, 4.5 to 5, or above 5%?
Looks like everyone's gotten more efficient at this polling process. Polls have come in pretty quickly, and this one we have the greatest consensus so far. So why don't we give them a few more seconds, and we'll wrap up. So get your answer in and close the poll. 9% think it's going to stay low and below 4%. 19, 4 to 4.5, a slight uptick. 4.5 to 5 is 13%, and then a majority, 60%, feel the cap rates will be above 5% before the end of the year.
Ooh,
So that's the
that's a little scary.
group we've had.
Now, of course,
What
I was asking this question in the context of institutional real estate. So it may be that the property, what some of them have in mind is property types that already have a little higher cap rates. But it sounds like there's a general consensus, or at least on average, that they're going to go up to some extent. So here we're talking about the returns by property type for the current quarter compared to the last quarter, and you can see, not surprising, hotels just really got killed, and then retail. What can you say about retail? Big question is to retail was already in trouble, and then when they all had to close down, that just really hurt for the quarter. People not paying rents. Surprising from a lot of what I've been hearing, people are collected a lot more of apartment rent than they thought they were going to. Pretty high percentages of tenants paid their rents, especially on workforce housing. That seemed to be, from some calls I've been on, where they got the best results in terms of collecting rent. You think it might have been the opposite, but workforce housing rentals was a very high percentage. Industrial, of course, has continued to be the best performing of the property types. Its returns were down, but still, 2.5% on a quarterly basis, 10% on an annual basis. We'll take that. Office, down a little bit, but still holding in there. So apartment, industrial, office, hanging in there. Hotel, retail got killed. And then just another look at by property type. The gentleman from Hines actually was making the note on the slide: record spread between retail and industrial returns. We've I don't think hardly ever had that kind of a spread between two property types, where industrial, just doing much better than everything else, and retail doing much worse than everything else. And then cap rates by property type. Not a surprise that retail has gone up, but and we don't have hotel on this one. The other ones are all kind of holding steady. And then the NOI growth, again, not a surprise. Retail had the lowest and has been dropping NOI growth, whereas industrial has the highest NOI growth. You really start to see a story after a while when you look at it different ways, and it's all pretty consistent in terms of what the underlying fundamentals are that are impacting what we're seeing in performance of the different property types. Vacancy rates highest, but coming down for office. Although again, this it is going through the end of the quarter. We'll have to see what happens as we go into the second quarter. Retail vacancy starting to go up. Industrial holding steady. And there's arguments that industrial could continue to really perform well. If we bring a lot of the manufacturing back to the US, you're going to need that industrial space. So this might be a little harder to answer than it's been in the past. What property sector do you think will perform the best in 2020? Will it continue to be industrial? Or could it be apartments? I don't know if anybody will pick hotel or retail, but never know.
We came in fast with the answer on this one, and everyone's done, so we're closing the poll early. The results wouldn't surprise you, Jeff. 79% industrial, 21% apartments, 0, 0, 0 across the board for office, retail, and hotel.
Okay. Now, of course, by subtype, we could have different answers. Grocery anchored, retail, you know, may do quite well. This is another graph from Heinz, and what they were looking at is and I added some labels here that make it a little bit easier to see what's going on. The bottom axis, the x-axis, horizontal axis is last year's growth, and then the vertical axis is the last quarter growth, but put on an annual basis, just multiplied by 4. The point being, if you're below that line that goes through there at a 45-degree angle, this year's growth is less than last year's growth. And you can see that just about every market in the country, with some exceptions, is below that line, where we have less growth now than we had a year ago. Washington above the line, Dallas above the line, Portland above the line, and I guess that's about it. Denver way below the line, Phoenix way below the line, Boston way below the line, and so forth. These are the kind of things, of course, the institutional investors and national developers are looking at what's happening to different markets and what's their price momentum. And then this is another graph that Heinz had put together. I'd never seen this before. I thought this was kind of interesting. Labeled "Time to Keep an Eye on the 90-20 Rule." Okay, and the idea is when 90% of the markets have less than 2% growth, okay, your 92 rule, that's the time to sell. And you can see we've just hit that, where 90% of the markets have less than 2% growth. So this is kind of like, Jeff, you see in the stock market where people do charting, right? Say, look, here's a buy signal, here's a sell signal. So they're saying it's pretty accurate that when 90% of the markets are less than 2% growth, that kind of indicates maybe it's a time to sell.
It certainly looks like they've been ahead of the curve historically based on that.
Yeah, so interesting. Have to track that one going forward. And then Heinz also was pointed out that CapEx has been increasing, especially for office. Look at how the CapEx has been going up on office properties, that red line. As a percentage of the net operating income, you're at what, 65% of net operating income is CapEx and rising. And it's hard to imagine that's not going to keep rising. I mean, what are they going to have to do to office going forward? A lot of partitioning, right, and spreading out of people, and reconfiguring the space. You think there'd have to be more CapEx going into office properties. The lowest is apartments. You'd expect the lowest to be on apartments. And so that's resulting in, of course, a lower cash flow yield for office compared to the other property types, with although retail here is the highest in terms of cash flow yield. So I also gathered some different opinions from different folks in terms of where they think or how they think different property types are going to be impacted by COVID-19. So in this case, a white paper that just recently came out called "Value Sustainability: Real Estate Values in an Era of Pandemonium." It's just published May 12th by the Archtone Group Value Expos. And you can see, and I won't go through every detail of this, but you can see what they think will have the most volatility would be lodging, office, malls, and strip retail. The least volatility would be student housing and manufactured housing. I'm not so sure about the student housing. We've got some universities that are going to bring students back to campus, but others that at least for the summer and first semester next year are going to be strictly online using Zoom and other tools. That would seem like it's going to hurt student housing. So I don't know about that one. Medium volatility, healthcare, apartments, storage, and then not too much of a change would be your net leased assets. kind of makes sense. A lot of the, of course, the pharmacies, the CVS's, Walgreens are net lease assets, and I think they're benefiting from this. And you can see the chart shows the projected changes in vacancy rates and NOI growth, et cetera. And then CapRight, actually the president of CapRight did the webinar with me for the institutional investors, along with a fellow from Hines. And so these are some market observations that they went over in the webinar. Just highlighted a few things here. Market rent growth is going to be flat to declining, at least in the near term. Retail sales growth is likely to be down across most property and tenants, although with grocery and big box should be holding steadier. Of course, going to be a lot of rent restructuring. Landlords are inundated, and solutions vary very widely. As Jeff mentioned, we're working at RealNex to try to enhance our lease analysis solution so that you can compare different lease alternatives and even see the accounting impacts under these new FASB rules that require the tenants to put the leases on their balance sheet, which we didn't have to do in the past. And then credit loss is expected to increase significantly. Certainly near-term vacancy likely to increase in most areas. Cap rates holding steady so far, but as we've seen from our survey responses, we think that that's going to have to budge at some point. But certainly right now, the focus has been on rent collections and how that's going to impact cash flow. And then finally, I don't know if they have made this public yet, so it was shared with me by, I'll just say, a major state pension plan, where they first prepared this to present to their investment committee to let them know what's happening with real estate. And I thought this was interesting how they rated from the risk being higher to medium to lower across these different property types. So at the lower risk spectrum, you got data cell towers. That makes sense. We're gonna need a lot more of that, especially if everybody's going to be doing. Not everybody, but there's going to be more working at home and online meetings and so forth, and 5G adaptation. It's going to be continued need for data centers and cell towers. We're going to need more industrial spaces. There's more home delivery, higher demand for cold storage. Multifamily is more necessity based, and there's been a housing shortage there. Self-storage, and then medium office. That's a little harder one to gauge, especially of course the shared office space. And then higher end of the spectrum. Now here I agree with this one. Student housing. Here they have it on the high end of risk. Senior housing. We've seen where the COVID-19 has really impacted nursing homes, so that's got to have some risk for senior housing, and we've already beaten retail and hotel to death. Any surprises there, Jeff?
No, I think that's right on target. I mean, with data center and all of the things, activity online, there's tremendous demand still, and as you mentioned, the Amazon effect continues on the industrial side. Everything is being ordered online and delivered, so they'll continue to stay. One of the things that this didn't point out and talk about was the migration from city center into the suburbs, and maybe part of that multifamily is playing out there as well, where there seems to be
I saw
a change
about that. Yeah, people are, a lot of people leaving New York City now and looking for houses outside of the city.
Yeah.
So good. I thought this was an interesting chart. This was done by a former student, so it has to be right. Collapsed deals. This came from another one from Real Capital Analytics. Collapsed deals as a share of closed deals. Look what happened in March. Just jumped way up. But of course, people that are participating in this webinar, they're seeing it every day, I'm sure. Collapsed deals by property type. So you got apartment, office, retail, industrial, and hotel in terms of the percentage of collapsed deals. So I guess not surprising. Well, let's see. If we, this is comparison what we currently have with the great financial crisis. So more impact on office. You wouldn't, it's a little surprising maybe that that's the highest percentage
Well, I
of
think
collapse deals.
it's interesting. In the financial crisis, that was just across the board
Right,
cash
right.
squeeze. So that was broadly by property type. This was so severely directed at people working from home that that hotel and retail piece seemed to make sense to have spiked up above
Right,
and
and
be different.
industrial being small, wouldn't expect much of an impact on the industrial deals. Okay, and then monthly deal volume. You can see how it dropped way down again from Real Capital Analytics. And then co-working under pressure, and on the slide from Heinz. This, in this case, on a global basis, but just indicating that you know, where there's exposure to the co-working, because that's certainly going to be under pressure as a result of the crisis. And then investor risk perceptions. Again, this came from Real Capital Analytics, so you can see how risk perceptions have gone way up. And if that continues, it kind of has to push cap rates up, in my opinion, because cap rates are a combination of risk and growth expectations. And if perceptions of risk go up, that's going to force cap rates up. Of course, we come up with a virus, and a lot of people working on it, and news every day about advances. Hopefully, we will have a V-shaped recovery, and not U or L or whatever else. Hopefully, it's not a W, up and down and up and down. So I think this might be the last question. How long will it be until returns are increasing again? Is it going to be the third quarter of 2020? Based on the previous poll results, might have some votes for that. By the fourth quarter of 2020.
The question is, and I'll set up the poll, hopefully he'll get back in. How long will it be until returns are increasing again? The third quarter 2020, fourth quarter 2020, first half 21, second half 21, or is it going to take us into 2022 until returns come back positive?
I didn't allow him to do next quarter, but it sounds like a couple on this call would have voted for that.
Your audio is breaking up a little bit, Jeff, but you're
oh, okay.
Back now, but it was still a little bit warbly.
I was just saying I didn't allow for next quarter. Some people on this call may have voted for that.
So let's close out the poll.
Jeff, can you hear me? Can you hear me?
I can hear you now. Yep. Yes.
Okay.
Yep.
Did you go over the poll results?
I did. Yep. You're back in now.
Okay. I don't know what's going on. I got pretty high-speed
Lost
internet
you for a minute.
Huh. Okay.
Need more data centers and cell towers. Like
yeah.
you said, that's.
Jeez. Okay. So summary, based on what we know or knew, the end of the quarter, returns slightly positive for all property types combined, but lowest return since first quarter 2010. Returns down for all property types, but negative for hotel and retail. Cap rates holding steady, but quarter end values only started to capture the impact of COVID-19. We've had lack of transactions and so-called price discovery to know where values will end up, and lots of speculation, as we saw, as to what the new normal will be. So stay tuned. We'll try to keep bringing you information on what we see happening in the market, and keep calm and live healthy. Jeff, did you lose me again?
Sorry about that. Yeah, Jeff, we had so much in the deck. I wasn't sure if we were going to have any time for Q&A, but we do have a few minutes, and there are some questions that have come in. And let's see. You
I can use
can
my
use
bad I can use my bad internet for an excuse to make you answer them.
you can use the question box to chime in. Some people we're asking, will the deck and the presentation be available? Yes, as always, we'll get this posted up after the weekend. So not this time Monday with the holiday, but Tuesday for sure we'll have this out in a blog post and up on our YouTube channel. So come take a look there, and you can get the link to that. A question: what is your opinion of property values versus appraisals when the NOI has decreased by 30%? Should an appraiser take a 3-year NOI average to determine the NPV or discounted cash flow?
Well, I think when we do it, yeah, I've always been a big advocate of discounted cash flow analysis. So I think you project what you think is actually going to happen. You never average things. You only average NOI sometimes when you're trying to do a cap rate to get more of a stabilized cap rate. But I think we project what we actually think is going to happen to the NOI, which could drop for a quarter or two, and then maybe even come back. Just a question of how long to where we are now.
And the question would be, does the discount rate change that you have to put against that, given the
that gets us
environment?
back to the risk premium. I think the discount rate reflects the risk premium, and without getting too technical, a cap rate is basically a discount rate minus your expected growth. If you reverse that, the cap rate is like a current return. Your discount rate is like an IRR, which is your current return plus growth in value. So if the risk goes up, the discount rate goes up, which pulls your cap rate up. And then if expected NOI growth is going to be less, you need an even higher cap rate to make up for the fact that you're not going to get the growth. So all those things that we need to figure out right now: what's going to happen to cap rates and risk premiums, and then what's going to happen to NOI growth.
So there was a surprise, and one of the participants asking why do you think the office vacancy was so much higher than retail, given what's been such a challenged retail environment even before the crisis here? And I know one of the answers, a lot of retail has been converted, so a lot of what was retail is no longer retail. So that's part of the answer, and I think office also historically just has maintained a higher vacancy level given the construction volume to put office in place, and it's built in advance of demand. So just
right,
Jeff,
probably
what's your
and a lot of the new shared office space that came online, increasing the supply side.
Yeah, I think that in that part of your chart that you didn't go into in depth, but WeWork was gobbling up a tremendous amount of space, and that's going to be coming back and will continue to come back on the market. But that's a changed environment as well.
Yeah, that's one Sam Zell never believed in.
No,
shared office space.
When that IPO came out, he called it out of the gates. Any chance of ground up construction, or what do you see that looking like versus the financial crisis?
Oh boy. I don't know that anybody would want to start a new construction project right now that was spec, right? I can see build to suit if it's space that a tenant says, hey, I really need a new type of space going forward than is available in the market now. I can't reconfigure existing space to do it. I'm not sure why that would be. You wouldn't be able to reconfigure the existing space, but who knows what we're going to need going forward, right? We're going to need more space
I would
per
think that
employee. There's going to be less people maybe going to office space, but then for those that are going to office space, then they need more space per employee than in the past, more partitioning. So there's going to have to certainly be a lot of reconfiguring of space.
It would seem that until the market stabilizes and it's understood what the new normal is, banks aren't going to be too anxious to put a construction loan out. So I can't see that a lot going on in the short term. So for us, maybe until the end of 2020, the question sort of pushed out into 21. Certainly, if things stabilize and there is a vaccine or other treatment and people are back to work and life gets back to a known new normal, and you can forecast more effectively than you can today, then that market will return. Just have still have a few more minutes and a few more questions. Do you believe once government payments stop at the end of July, we'll see another move in the market? What's that going to do? What you talked about, that your surprise on the workforce housing. In many cases, with unemployment, people are getting more pay than they were at work, which is sort of
right. Although you'd think some of them might have taken advantage of the situation and said, well, I'm not going to pay my rent because you can't evict me now.
Yeah.
Like I said, I was on some calls with people that own workforce housing, and they said, hey, those tenants have pretty much all been paying. On the other hand, there's some retailers. Somebody mentioned that Starbucks is saying, I'm just not going to pay my rent this quarter or this month. I can't imagine that they don't have the money to do it. I've never been to a Starbucks that wasn't busy, and I think a lot of retailers, and one of the advisors to the IU Center for Real Estate Studies, who was on a call that I was on that does a lot of retail, was saying he's finding tenants are taking advantage of this. They're not paying their rent, but they're using the money to expand. So a lot of gaming's being played right now in the market, I think.
One final question, then we'll wrap up with a huge deficit growth. Where do you think interest rates will be in 3 to 5 years? Do we stay at these historic lows, or do they have?
Yeah, I think the government's going to do, and the Fed's going to do everything they can to keep it down. As the deficit goes up, the last thing you want to do is have rates go up to have to pay at higher rates. And we also still have higher interest rates than almost any other country.
I guess the bigger question is, and this is going to be the real challenge, and it was out of the financial crisis, and it didn't come out. It didn't play out the way people thought, is that there's going to be rampant inflation, and it just couldn't get any inflation. So I mean, the only reason that the rates would go up is if inflation got out of control. I guess we just have to.
I just got a letter from I had moved some money into a money market fund in my TIAA retirement account, and I got a letter or email a couple of days ago that said we may have to go to negative interest rates. So I have to pay them. I have to pay them to have money in their money market account. So that kind of tells me that at least they don't think rates are going to go up. They think they're gonna stay low. And they were sort of warning me.
Get your money out of here.
Yeah, or be prepared to pay to have my money there. Trouble is, I don't know where else I'd put it.
Well, maybe there's going to be some good opportunities in real estate for you to take advantage of.
All right, well, this has been fun. It'll be interesting to see what happens next quarter.
Well, thank you all for joining us. Thank you, Jeff, for another very insightful session. We hope you're all doing well. We wish you well. Enjoy the long holiday weekend, and we will again get this posted up next week for you to share and review, and hopefully it'll help you in your practice. So again, thanks for joining us, and we will see you next time. Have a great day. Bye-bye.